Bond Valuation and Time Value of Money, a presentation by Prarup Acharya. What is bond? Bonds are stocks issued by corporations, governments, or any private companies. They are generally used to raise capital. Bonds give periodic returns as interest payments to the bondholders. Bonds are returned of principal at the time of maturity. Bonds are safer because it offers fixed income as periodic returns on interest payments and return of investment at predefined rate and time. Risks included in bonds are inflation risk, credit risk, and interest rate risk. Inflation risk is due to the inflation in the economy. Interest rate risk is due to the increase in interest rates on the market. So interest rate risk is uh, inversely proportional to the bond value. Bond valuation and valuation methods. Bond valuation is the process of determining a price of the bond. This valuation is very important when an investor is trying to buy or sell a bond. There are multiple types of valuation methods. So, present value method is used because uh, in it discounts the bond's future cash flow to present value using a discount rate. Yield to maturity. In this method, the rate of return on the bond if the bond is held till maturity. Yield curve, relationship between maturity and bond yield. Question number one. According to the questionnaire given to us as the assignment, uh, question number one is which explain which bond will trade at higher price in the market and why. Since bond B has a shorter time to maturity, it will trade at a higher rate. It's because any investor prefers bonds or investment that offer returns sooner than rather than later. This in turn raises the present value of the bond, impacting its higher rate on the trade floor. Reasons behind bond B's higher rate. Maturity period. Maturity period is a date where the bond issuer has to return the principal of the bond to the holder. It affects both investors' preference and pricing of the bond. Usually, bonds with higher maturity date have risk associated with it, resulting in less preference of the bond. Interest rate risk. It is the fluctuations in interest rate that ultimately impacts the market price of the bond. When interest rate rises, the bond's market value decreases and vice versa. In our scenario, since bond B has lower maturity time, its fluctuations are less risky and preference of the investors increases. Since interest rate risk is inversely proportional to bond's market value, when interest rate rises, the bond's market value decreases. Liquidity premium. Short-term bonds typically have higher liquidity compared to long-term bonds. This indicates that traders can trade bond B more readily in the market, boosting its appeal and potentially causing its price to rise in comparison to bond A. Since bond B has less maturity period, investors might see a preference to bond B because they can cash out at earlier period and reinvest the principal in other ventures or avenues. Let's take an example. Bond A and B have following values: a coupon rate of 10%, annual coupon payment, par value of $2,000. Both on our example, both bonds have same credit rating. So we can calculate the prices of both the bonds, assuming market rate of return is 4%. Market rate is 4%. For bond A with 30 years of maturity, the price of the bond A, as we can see from the formula below, the, uh, it results in $4,075. Bond B with maturity of 5 years. The price of the bond B results to $2,538.16. On the basis of this calculation, value of bond A is $4,075 and value of bond B is $2,538.16. Bond A with its higher maturity period than bond B is valued at higher price. Question number two. Market value of bonds generally see a drop when interest rates of the economy rises. The basic concept of investing in bond is the opposite relation of bond value and interest rate, which is also known as interest rate risk. Let's examine the impact on each of our bonds. Bond A with maturity of 30 years. Bond A has a higher maturity period. This gets affected by interest rate fluctuations. If interest rate rises, newly issued bonds have more return than older bonds. In these conditions, investors will require higher return to make up for bonds with less coupon rate. This demand for returns result in decrease of price on the market for bond A. With comparison to bond B, bond A will experience greater drop in the market value. Bond B with maturity of 5 years. Bond B has a less maturity and is less affected by interest rate fluctuations. Investors prefer to keep bond B due to less risk involved in interest rates, and its cash flow can be reinvested for higher rate of return. As a result, bond B's price drops, but the decrease is smaller than bond A. Numerically, we can see that uh, from previous example, let's assume the market rate has increased to 5%. For bond A with 30 years of maturity, we can calculate its price of the bond A as $3,537.2. And similarly, with the same hypothetical market rate of 5%, we can calculate bond B's price of bond B, resulting to $2,438.9. The example given above shows that with an increase in market rate from 4% to 5%, bond A's market value decreases from $4,075 to $3,537.2. In the same way, bond B's market value drops to $2,438.9 from $2,538. Question number three. The greater price change in bond value can be identified by taking into account duration of both bonds. The time frame or maturity time of a bond is directly related to effects on it due to fluctuation on interest rates. Bonds with higher maturity time period, like bond B, will have more price change due to interest in change in interest rates. Since bond A has a greater maturity time period, that is 30 years, in contrast with bond B, that is 5 years, it is certain that bond A will be affected more due to fluctuations in interest rate. Taking into considerations the examples provided in question number 1 and 2, the percentage change in price for bond A can be calculated using new price and initial price. The given formula gives us the result as 13.19% for price change in bond A and 3.09% in percentage change of bond B's price. Thus, bond A experienced a greater percentage price increase related to bond B in numerical terms when interest rate increased. This is in line with the idea that longer maturity bonds usually have more price sensitivity to interest rate changes than shorter maturity bonds. Finally, a decision that investors have to make: which bonds should they choose, a longer term or a short term bonds? This usually depends on the portfolio and investment strategy of the investor. Investor can choose bond A if they are looking for a long-term stable bond, if they are willing to accept interest rate risk for potential higher reward in the future. They can choose bond A if they expect interest rates to stabilize or decrease over time in the future. Investors may choose bond B if they are looking for short-term investments and quick returns. If they think interest rates will grow in the future, if they think li- if they want to liquidate early and invest in other ventures. On the conclusion, the decision of choosing a bond between uh, different maturity years uh, directly falls on the preference of investor. What are their preferences, what returns do they want, and what risks they are willing to take. These are the references that were taken during the creation of this presentation. Thank you.